Good morning, ladies and gentlemen. Well, I've been telling you to ignore the risk dial for weeks now, and I think it'll be several weeks before it gives us a tradable signal for the long term. While the scores are this low, around the 0 to 15 to 25 or whatever, it's going to take an age for these moving averages to cross over and give the next signal. So I think it's another period of sustained stability, as they say, and we will not be moving very far in any asset class, and I will examine that in detail throughout this video. Well, the NFP number certainly put the cat amongst the pigeons. We can now see that rapid cuts are not going to happen. We can now see that there is very little chance that anything that the Fed penciled in its summary of economic projections is actually likely to happen. Yes, the Fed will continue cutting, especially if CPI continues to miss to the downside over the next couple of months. But the odds of inflation going down below target while the economy puts on 250,000 jobs per month, and also the wage data is above consensus, is very, very low. And therefore, I think it's much more likely that the market consolidates and that the yield curve actually starts flattening again, and we got out at exactly the right level. And now I think levels like this in the 2s, just above parity, are more likely than not to happen, and then we have another swoon down sometime towards the end of the year. But for the time being, the yield curve has absolutely stopped steepening and will now flatten somewhat. It is now terribly unlikely that we get anything but the sort of best case 225 cuts this year and then 4 cuts next year. What is that dependent on? It's dependent on inflation staying benign. I think what the Fed is going to do is ignore the last 30-40 basis points of PCE getting to target, i.e. they won't mind if it's 2.25, 230, 240, and will continue cutting as long as inflation is well behaved and the economy is chugging along at the pace that it is at the moment, i.e. 2.5% to 3% real GDP growth. They won't mind that. They will mind any reacceleration of inflation, but I think that for the time being is unlikely. And I've put in these values, and you can see that the curve in 2025 is still about 30 basis points rich towards that, but that is understandable because they are always going to price in some odds of faster cuts than the Fed penciled in itself in the SEPs. I don't think that is likely to change for a long time, but what we have done now is we have gone back to 225s with 0% odds that it's going to be more. And I think that that is sensible and it's not a problem. The bond yield curve should normalize. Now, I think it's pretty obvious to everyone that the US economy is just fine. It's resilient, it's chugging along, and we are going to have an inflation rate somewhere around the 2 to 2.5% for the foreseeable future. CPI is normalizing. It is PCE will normalize with it. And as long as the Fed doesn't particularly mind the last 30, 40, 50 basis points, as I've said, and I don't think they will still err on the side of easing. We should have a curve between 3.5% and 4.25% for 30s. So 30s are actually priced in. What is not priced in is a perfectly straight curve with 2s probably slightly lower, because let's face it, why would Fed funds be much more than 100 basis points over the inflation rate? I think that is unlikely at the end of the easing cycle. And then the yield curve should be completely normalized between, let's call it 3.5% for 2s and 4.25% for 30s. What I think has to disappear is this kink, and I think all of these, the 3s, the 5s, and the 10s, which are not really the 10s, but the 7s, need to go higher, while the T-bond and the 30s more or less stay at the same level. So let's have a look at the 5s 30s, because that should be the one that reacts more. I would not be surprised that over the course of the next couple of weeks, especially if CPI and PPI and hence PCE are as expected, we see something like minus 37, this kind of level again in the 5s 30s. So that's another 7-8 basis points that basically the curve can go. If we have a look at the 2s, I very much doubt that they can go through 406. I think we'll probably test it at some stage next week, but unless the CPI data comes in hot, we will not see it through 406. 5s, I think 5s are going to break the 382 level and are going to trade somewhere around here, around the 394, the 395 level, and that is going to be all she wrote. In terms of 10s, this kind of level, 408, I can't see them through there, and the 30s, I really am beginning to think that the 30s are not going to break 433. This 433, 434 to me is going to be a very good level at which to buy 30s. If we switch that to a TLT view, and this is of course subject to the CPI being in line, and I really don't see why it wouldn't be, I really suspect that this 94.20 area to 93.60 is going to hold it for a nice bounce back up to 96, 96.5 and close this gap. Let's not forget that it's inflation that the 30s and the long end responds to. It's not so much whether the economy creates 100,000 jobs or 200,000 jobs in any given month. And therefore I think that this kind of level between 94.20 and 93.75 gives us odds of a decent sized bounce. And this then becomes a sort of ABC and then we see kind of thing. I think that the risk reward is definitely to buy it first time round. This is the 2s, 5s, 10s butterfly, and I will be showing that much more from now on. I think it's going to go down towards the 0 level. I think the curve needs to normalize. I think we have all the data that we need, i.e. that the economy is still fine and that inflation is going down towards the target. It might not get absolutely to target over the course of 2025, but it will be precious close unless we have another reacceleration in the economy, which I find it hard to see, and also a reacceleration in commodity prices, which I also at the moment find hard to see. Given the information that we have at the moment, I think the 2s, 5s, 10s butterfly needs to go over the course of the next 6 months or so down towards 0. And the important level is going to be this around 25. So I would wait for a bounce towards 35 and then look to put on the butterfly, and I will naturally tweet it for you. The German curve naturally reacted far less to the NFP number than the US, as is normal, But what it tells me is that we are in a period of stability there as well. The ECB will cut, but so will the Fed. So I don't think that the Schatz is going to go too far. I think if we see this kind of level, 233, we definitely would be looking for small adjustments back down. But the one that is pretty obvious is that the tens are not going to go much higher than this level, 232, 233. We're going to slowly turn this moving average back down, and it's actually a good signal that we are likely to see this 233 level again, but that it's unlikely that we're going to break it anytime soon. This is Schatz against the 2-year note. I think it's got 180 written all over it, but I think that we stop there certainly next week. And certainly if CPI is in line or maybe even slightly cold, that should be all she wrote there. And fives, as you can see, we are, getting there more or less. I don't think that we can go through the 180 level either. And tens, it's got like 182 written all over it, but I think at 182 what it's telling you is that any kind of a backup in the US is probably done. It really is unlikely to go through there, unless inflation starts accelerating. So if we see 182 in the differential before the CPI number on Thursday, I think that it's probably worth a short there. And so far, September 25 against December 25, I'm not worried at all. I think if it comes down to this minus 12 area, you double up, you triple up. Because if the curve goes normal again, this has to go positive. Why would the curve not go normal again? The curve being anything but positive is unnatural. If we have an economy which is chugging along nicely and say that we normalize again to the 150, 175,000 jobs per week in non-farm payroll, and inflation is down at 2.25% to 2.5%, why would you expect Fed funds to be any lower than 3.25% or something like that? Why? And in that case, why would you expect a continuation of cuts forever? Why not have a normal positive curve? And to me, any time that the market realizes that we are going back to a nice normal positive curve where Fed funds are 75 or 100 over the PCE, which is restrictive enough, I would have thought, then this spread absolutely has to go positive. I've been telling you for weeks now that down here, DXY being short of it is a very bad risk reward. I would rather have shorted closes below 99.80 than shorted at 130. The risk now is that we break 102.80 and that we trade around here 103.70 up to 104.10 or something like that. That is the risk. I think that given the fact that I think that tens are going to stop the differential around the 182, 183 against Germany, it's unlikely to me that we have the legs to break above 103.80 or so. So that is the kind of level that you can look for, another percent in DXY, but I wouldn't have thought we're going to go much higher than that for the time being. Certainly not if the PCE is not the PCE, the CPI and PPI, and therefore the PCE are in line. Because the Fed cares most about inflation. It's still going to keep on cutting the 25 basis points in November and December, if inflation is in line. If inflation is not in line, then all bets are off and you get a real flattening of the yield curve, a real big differential builds up, and then the dollar can go quite a bit higher. I mean, I really would not be surprised in that case if we go even to 105. But for the time being, before we see the CPI numbers and therefore the PCE numbers, and there is really no reason to expect them to be anything but in line, I actually expect them to be slightly lower than the market is looking for. I would have thought this 103.75 level is going to be the top. If we have a look at what that means for the euro, I would have thought this 109 area or just below 108.75, something like that, is going to be as low as the market gets before the CPI number, and then we see. But certainly this kind of level would not be out of the question, but I would have thought it's actually a good risk reward to look for a bounce from there. Gold is consolidating, but what it's not doing is coming back more than the bonds are, and certainly not coming back more than real rates are, which tells me it's still a strong market. It could easily trade, 26.30, 26.15, but I would have thought that that kind of level is all it's going to do, certainly before the CPI. It's doing nothing wrong still. What it is doing, it's actually coming back against DBC, and if we look at this chart, it's likely to come back slightly, which tells me that it's still in an uptrend, and I still think that gold is going to do better than commodities. But what it does tell me is that commodities are going to be bid for the next couple of weeks, and I certainly expect this 23.90 to 24 level to trade in DBC, and that actually tells me that oil has some potential up towards the 77 to 78 area, but I don't think it goes through there. I don't think that we are in any way in a new bull market for commodities. I think this is just all trading a retracement, and that eventually, once we've touched this kind of 79, 80 area, we come back again and test the low 70s. So this is going to be maybe 1 or 2 weeks of DBC doing better than gold and retracing, which is healthy, but I don't think it goes very far indeed. This is risk parity, and I think that we have topped out for the time being, exactly at the level where I drew the line and I told you that we would top out. 2070, and this tells me that it's a bad time to carry too much risk, whether it be equities, whether it be bonds, i.e. it's a trading period. And I really wouldn't be surprised if we really now trade between this 20 level and this 2060 level for quite some time. And that tells me that all risk assets are going to be in a range, whether it be gold, whether it be equities, whether it be bonds. Yes, there's going to be a little bit more of downside here, but I wouldn't have thought a huge amount. I think we could probably stay in this area for a month until the election, and then we see. So I think it's sideways for all risk assets, and that colors and determines my view of what equities can do. And this is ITOT over government. Yes, this chart does say to keep on preferring equities over bonds. But I don't think that we're in a position to start breaking to new highs until the election. I think we are far more likely to go sideways and maybe, sucker some people into buying it up here and then coming back. But yes, I think this kind of action sideways to wedging is much more likely than a clean break and a trend upwards. I would much rather see it stay here and break after the election or just before the election than make a break now, because a break now doesn't really make all that much sense. There's far too much danger from the election, and therefore, why break now? That doesn't make a lot of sense to me. I think people will still prefer to have some money in the safety of TLT at 435, 440 yield rather than go in all in on equities. That doesn't make any sense to me, and therefore I think that we will remain in this range, maybe go a little bit higher, but come back. And that actually ties in with the R-part chart that I showed you, where all assets stay defensive for a while. So last week, equities basically did nothing. They closed where they opened on Sunday evening, and we got the range absolutely right. 56, 70, all the way up to unchanged. And what is it doing is just basically crawling up this Bollinger Band on the weeklies and support from the moving averages. I think that is the continuation for the time being. I think equities do trade better than bonds, but I think on Thursday, if we get a bad number for CPI, I think all assets are going to go down, because I don't think that earnings will be strong enough in the S&P to negate the multiplier that the bonds coming down will have on equities. So I think the CPI is important. I do want to buy bonds before CPI because I think the CPI is going to be low, if anything. But if it's not, what I'm saying, then every asset suffers. Maybe apart from gold, but certainly equities suffer less than bonds, but bonds will suffer and they will drag equities lower. So my view for the week is, if CPI is, as I think it will be, good, you want to buy bonds before the CPI at the level that I showed you in TLT, and you want to buy equities on dips, because I think equities will then trade to the Bollinger Band, which was going to be around 58, 58.05, something like that. But we will definitely see that kind of level if the CPI is good, and therefore bonds can support equities. Otherwise, I think even equities have to swoon, probably less than bonds, but not much so. So if we start breaking that TLT level of 94.25, I believe, then equities will be in trouble and will probably trade all the way down to here, which is going to be 56.35, 56.40, something like that. That's going to be the natural support. Equities will suffer, but less than bonds. Another reason why I don't believe that we can power ahead in equities is because the EEM chart, I don't think, is going to allow it. I think we are going to have repeated tests of 45.04, and that tells me that equities in the US are in a range as well, and that this kind of euphoria that we got in China is likely to retrace to 45.04, but several times over the course of the next few weeks, but then go. I am getting quite bullish of EEM once it proves to me that it keeps on coming back to 45.04 and holding, something like it did here. And then I think that towards the beginning of next year, we can really power ahead in EM, and probably even relative to the US. But for the time being, I really don't think that we're in a position to start going on EM, and that really colors my view of equities. What with the RPAR chart, what with the ITOT over government chart, and EM, and the fact that NQ really is not leading, that tells me that we're in a period of relative stability. We might go up 1%, down 2%, up 1%, but net, I don't think that we are trending at all in equities. I think this is a period in which risk assets are being divested and risk is being lowered in case something happens over the course of the rest of this month and especially the first half of November. While we are within a few ticks of all-time highs in ES and SPX, we are nowhere near lows in the VIX. And I think that that tells us that the market is going to be unable to make any break higher which is sustained and which is a trend. I think that VIX has a very good chance on any kind of bad news to try and trade this 2280 level. But I also think that that stops it and it comes back. And that's another thing which makes me think that CPI is going to be a decent number and that we shouldn't fear it, and that any kind of pullback in the bonds towards the TLT 94.25 level is actually a trading opportunity rather than anything else. I still believe the yield curve is normalizing, and I still believe that equities are going to be a better long-term hold than bonds, but I don't think that we are ready to make new highs on RPAR which are sustained, and therefore it's still a period of sideways. And with that to the levels, I've changed everything, and the steepening phase is definitely over in the yield curve for now. Some mild bear flattening is still in order, and once we reach the levels, especially in the 30s that I showed you in TLT, that should be all she wrote at the long end. Of course, CPI will decide, but any weakness in bonds to the levels that I showed before CPI, to me, is a trading buy. And then we see what CPI brings. But I certainly believe that we have all the data in place that we need, unless CPI is bad. And I definitely think that after CPI, we have all the data that we need to start really normalizing that curve and realizing that, yes, R star might be slightly higher, but Fed funds will need over time to come down to about 100 basis points over the PCE. And if that is 2.25, 2.5, then Fed funds will come down to 3.5. And we're going to have a curve from 370 out to 425, 430 in 30s. 230s, 50 to 75 basis points is a very flat curve, so really it should be no problem getting there. And that has implication for equities, and it has implications for everything else. I still believe that it's equities over bonds over time, but it's the wrong time now to put it on. I think that you will have better opportunities, certainly before the election, and most probably after the election as well. So for the time being, my advice to you is be very light on risk assets, whether they be bonds or equities. I think you will have better opportunities to buy all of them. Thank you very much indeed, and tweet you on Monday.